So there's a brand new IPO hitting the market, Gaudium IVF, and honestly, this one's a real head scratcher. On one side, you've got these incredible growth and profit numbers, but on the other, there are some seriously concerning red flags. So today, we're going to unpack both sides of this thing to figure out what is really going on. And that's the big question with any hot new IPO, right? The hype is always there, but smart investing means looking past all that buzz. Is Gaudium IVF a rocket ship you want to get on, or is it a risk you should just, steer clear of? Let's dig into the numbers and see if we can find some answers. Okay, let's kick things off with their big headline number, a pretty staggering 58.74% success rate. In the world of IVF, which is so emotionally charged, a number like that is everything. It's not just data, it's this powerful marketing tool, and for patients, it's a huge beacon of hope. This is right at the core of what they're selling. Now get a load of this. Profit margins over 40%. I mean, just let that sink in for a second. These are the kinds of numbers you expect to see from a tech company in Silicon Valley, not a network of healthcare clinics. Profitability this high in the healthcare space is, well, it's almost unheard of. And it's not just a successful company. It's a successful company in a market that's absolutely booming. India's piece of the global IVF pie is on track to nearly double in the next 10 years. This isn't some short-term fad. It's being driven by these deep societal shifts, which means Gaudium is riding a massive long-term wave. So let's start with the good stuff, the bull case. What exactly are these impressive financials that have so many investors getting so excited about this IPO? First up, their return on equity, or ROE. At 41%, this is just exceptional. So what does that actually mean? Well, to put it simply, for every 100 rupees that shareholders have put into the company, it's generating 41 rupees in profit. That is a sign of incredibly efficient management. And here's that crazy profit number again, this time as the EBITDA margin, 40.48%. This means for every 100 rupees of revenue they bring in, over 40 rupees is pure operating profit before you account for stuff like interest and taxes. Again, for a business that runs actual physical clinics, this is just an astonishingly high number. This slide shows something that's really key to their growth. Their revenue per patient has almost doubled. Now, this is so important because it tells us their growth is coming from getting more value out of each patient, not just by cramming more patients through the door. It's a much more sustainable and profitable way to grow a business. All right, so when you look at all that, you're probably thinking, this is a slam dunk, right? I mean, tech-level profits, a booming market, amazing efficiency, but you know how it goes with investing. If something looks a little too good to be true, you've got to dig deeper. Okay, so now it's time to flip the coin. Let's talk about the hidden risks that are lurking just beneath those super impressive profit margins. And wow, this first one is a big one, a 63% staff attrition rate. That means last year, for every 10 people they employed, more than 6 of them left. In a business like this, which is built entirely on patient trust and the relationships with doctors, that kind of turnover is a major operational risk. It raises some pretty serious questions about the company's stability. So while they're making more money per patient, there's another trend that's a bit worrying. The actual number of treatment cycles they performed has gone down. So you have to ask yourself, is this just a little dip, or is it an early warning sign that maybe the growth engine is starting to sputter? Before I show you the next number, we got to get on the same page about a term you might see in their paperwork, contingent liability. It's basically a potential cost that might slam the company in the future if something uncertain happens, like, say, losing a big lawsuit. It's a problem that's just waiting in the wings. And the size of this potential problem is, well, it's huge. Gaudium is facing 45 crore rupees in these contingent liabilities. That's not just some number on a spreadsheet. It's a massive financial sword hanging right over the company's head. This slide really puts that number into perspective. The company's entire net worth is 59 crore rupees. These potential liabilities of 45 crore, that's more than 75% of the company's total value. If these legal cases go badly for them, the result could be absolutely devastating. Okay, so we've got two completely different stories here, don't we? On one hand, you have this incredible growth machine. And on the other, you've got these massive, glaring risks. Let's try to bring it all together and figure out a final verdict. So let's talk about the price. Is it expensive? Well, its price-to-earnings ratio, a pretty common valuation yardstick, is sitting around 23. That's actually a little bit below the industry average of 26. So what does that tell us? It suggests that while it's definitely not a bargain, they're not asking for some outrageous price either. The valuation seems reasonable, but only if you can stomach the risks we just talked about. So look, this really isn't a simple buy or don't buy situation. The right call here totally depends on what kind of investor you are. There are two very different ways to approach this. If you're the kind of investor who's all about high growth and you've got a stomach for risk, then maybe this is for you. The market potential is undeniable. If that's you, you might consider a small, calculated position, but you got to go in with your eyes wide open, knowing this is a high-risk, high-reward game. But on the other hand, if you're an investor who really prioritizes stability and you're not a fan of risk, then this is probably one you'll want to sit out. That crazy high staff turnover, the dip in treatments, and those huge potential liabilities, those are all giant red flags that a more conservative investor would have a really hard time ignoring. You know, if you had to boil this whole thing down to one single sentence, this would be it. You're getting the awesome upside of a tech company's profits, but it comes bundled with some really serious internal and external challenges. And so, that's the Gaudium IVF IPO in a nutshell. It's a classic investment story, right? A super compelling growth narrative smashed right up against some very, very real risks. The final decision isn't about whether the company is good or bad. It's about you asking yourself a simple question. Which one matters more to you? High growth or high risk?